How long you guys know each other?
30 years?
Mid-90s. We met at Westchester Capital. We were hired within, I want to say 8 or 9 months of each other. At the time, it was a small firm. We were managing less than $100 million in total. And as time went on, we opened up other products. Just in terms of our background, Mike's background is that he's a former M&A banker. And that's been very helpful in understanding the structuring of transactions, financing and things like that. My background is that I'm a former securities lawyer. I used to be a prosecutor at the SEC. And that's helpful because we read merger agreements for every deal that we invest in. The merger agreement is the contract that governs the rights and obligations of all the parties to a transaction. And it's not just me that reads it, all the analysts at the firm read the merger agreement also. It's probably the most important thing that we look at. So it's a good complement of skill sets and experience. Our head trader, Abe Carey, had been a fundamental analyst. He was on the trading desk of a large broker-dealer for a number of years before he came over. Our director of research, Rob Lynch, is a fundamental analyst, formerly of SocGen and First Boston. And so if you put all those kind of skill sets together, along with the data set and the database that we've developed over the past 30 years, it's kind of grown into a good background and a good source for analyzing the likelihood of the success of the investments and the events that we invest in.
So talk to me a little about the milestones in that evolution towards where we are today.
When Mike and I joined, it was basically a 3 or 4 person firm. And as the firm grew, the visibility of mergers and acquisitions and activists and hostile takeovers increased, and the visibility of our products grew as well. So as the firm grew and the products grew, and as people began to learn about the absolute return nature of our investments and the uncorrelated nature and the low volatility of it, the assets grew under management. And what started as a merger arbitrage operation expanded into a merger arbitrage and event-driven operation, and we also manage a credit an event credit fund as well, all of which are somewhat related with regard to the research process, with regard to the menu of investments that we can make. And we have a hedge fund, we have a number of mutual funds, we have a variable life insurance product, we sub-advise for a number of firms, and all of that occurred along the way. The assets under management have grown, and we have a variety of these products to serve the needs of different types of investors.
And looking forward over the next 5 years, people always ask, what's your 5-year plan, but where do you see the company evolving towards in the future?
I mean, it's a good question. Being part of the Virtus family gives us lots of opportunities in terms of access to investors that we didn't have access to before. There's a lot of capacity left in the space that we invest in. Event-driven investing has many, many billions of dollars of capacity, so it's not really capacity constrained. And as the economy goes through its ups and its downs, it's going to create different sets of opportunities. At one point in time, there were no SPAC opportunities. Now there's SPACs. During the financial crisis, a lot of banks and financial institutions issued these trust preferred securities, which were eventually taken out and created event opportunities for us as well. So we'll have to see what unfolds as we move forward, but it's likely that there'll still be plenty of opportunities in different kinds of events that we can learn about and take advantage of to our investors' benefit.
Yeah, it sounds like what you've effectively created is cyclical resiliency, which is always important for an entity such as yours.
I like that phrase.
So.
That's a good phrase, yeah.
Let's talk a little bit about the investment process overall and how you and the team think about things.
For the most part, what we're investing in is deals that are announced. So when a deal is announced, typically, we know who the company is. We've heard about it before. Sometimes not, but for the most part, we know the sector, we know the industry. The first thing for us that's important is, does it make strategic sense? Is the strategic rationale of the deal sound? Do investors like it? Because at the end of the day, we care about whether this deal is going to close or not.
Let me stop you there, because you're talking about risk management, which is important. And I know the answer would be, well, we don't think we can make money on it, but why would you pass on it? Why would you potentially pass on a deal? What is it that you would look at where you'd say the risk profile doesn't align with our process?
Well, we I think we're tracking around 210 trades around the world right now, and we're in roughly 60 or 70 of them. And that's typically been our hit rate. We invest in maybe 1 out of 3 deals we see. So we pass on a fair amount of deals. Oftentimes it's because it's not priced right. it might be priced in the market on an implied basis of it's 95% likely to go through. And we might just in qualitative research, talking to counsel and getting a feel for it, we might only be 85 or 90. So we think it's very high in likelihood, 85, 90, but it's trading on an implied basis in the market too tight, if you will. That spread, that return is not enough for us, given the risk that the deal might not happen. So a lot of the time it's not priced right for us. Other times maybe it's not strategically sound. Maybe investors don't like it. The acquirer's stock hasn't performed well, and we might need their shareholder vote. That may or may not happen. So is it priced right? What are the risks to the deal? Does it make sense?
If I can just kind of expand on that a little bit, there's a lot of things that we do in order to prepare for the investment. And if at some stage we see something we don't like, we won't make it. We read the merger agreement for every deal that we invest in the case of a merger. We look at the financing. We look at the shareholder vote. And most importantly, probably the biggest cause of terminated transactions is a regulatory blockage. And the most common regulatory blockage is antitrust approval. That's the US FTC or the DOJ. So we employ antitrust counsel to help advise us on what they think the odds are of the transaction clearing the antitrust process. But we don't just invest in mergers and acquisitions. We invest in companies that are emerging from bankruptcy if there's a reorganization plan that's approved by the judge. So in that particular case, our investment is predicated upon an approval and emergence because we know what we're going to get. Just like in a merger transaction, you have an idea what you're going to get for the target company when the deal's closed. When a company emerges from bankruptcy, you know what the reorganization plan is. You know what you're going to get paid for your bonds or your stock. If stock might not get anything because it's a bankrupt company. Other times we're investing based upon litigation outcomes or regulatory approvals in the case of like a drug transaction or drug approval. Other times there are FCC in the case of communications company transactions. So there's a lot of different types of events that we invest in. And once again, we'll do the homework, we'll hire counsel, we'll hire economists to help advise us on the likelihood of success of that particular event itself. And then if we are convinced that the market is pricing it inefficiently, as Mike was talking about, where it's implied in the market, what the odds are of it happening, if we think that we can get a research edge, gain some type of an edge on the market, either because people want to liquidate their holdings and they're selling into people like us who are buying it because the stock's up 10 points, whatever that may be, if we can find an inefficiently priced transaction, we will consider that for an investment.
I would add to it just that when we're looking at these deals, at the end of the day, it's what's the likelihood of it going to close or not. And what's interesting in this current environment, as Roy said, the DOJ and FTC have been challenging a lot of deals, but they've been challenging them, yet the laws haven't changed. And so just because someone's big like Amazon or Microsoft doesn't necessarily mean that they're bad. In fact, they're probably good for, at the end of the day, consumers. And that's how the laws were written. The laws weren't written to protect competitors. It was written to protect the consumers. And so they're bringing cases where they're worried about the competition, but they're forgetting that the law, the Sherman Act and Clayton Act, are the same laws that they were, and they haven't changed those. And with this administration, or with the House changing hands, they're unlikely to change those laws.
Yeah, while I have the two of you sitting here, I remember conversations that we had a couple of years ago when we saw the introduction of all the SPACs into the marketplace and the effect of that. Now, here we are 2 years later, we're reaching the maturity where a lot of these SPACs will either return the capital or what the decision might be. What do you see as the effect of all of that given the current climate, if anything?
So the SPAC universe got really large, and there were a lot of SPAC issuers looking for target companies to merge with. SPAC stands for Special Purpose Acquisition Company. Right. So that kind of falls within the universe of what we'll look at. We will look at companies that are being involved in mergers or acquisitions. But in the case of SPACs, you also have an added advantage in that if you own a SPAC and you don't like the deal that's announced, you can choose to redeem your shares for the amount of money that the stock went public for, which is typically $10. So you're kind of stopped out at $10, unlike a regular merger arbitrage investment where the stock can trade all the way down to its fair value. In the case of a SPAC, you're not getting less than $10. So we've actually, as our, our filings and our portfolio shows, we own a good number of SPACs because the worst you can do is realize a rate of return by buying the SPAC at a discount to the trust value. And if they announce a very attractive deal and it trades above that, then that's great. That's gravy for us. So it's a very low risk way of investing in mergers and acquisitions with the investment profile of a decent upside and literally no, if minimal, downside.
Roy, Mike, thank you, gentlemen.
Great.
Thank you very
John.
much. Thank you.